Hello everyone. Today I'm going to be talking about risk tolerance. Obviously, risk and investment come hand in hand, so it is important to understand it and learn how to manage it. So first of all, what is risk? Risk is the possibility that actual returns will differ from expected returns. There are two main forms of risk, which is your risk capacity, which is your financial ability to take risk, and risk tolerance, which is your emotional ability to take risks. So the amount of risk which can be undertaken differs for each person. So all of you in your groups will have different risk tolerance compared to each other. And why is it important? When you understand your risk tolerance, it helps you choose suitable investments, it prevents emotional decision making, it reduces panic selling during downturns, and it aligns investments with personal goals. Moving on, we have the five main types of investment risk. The first being market risk, where the entire market falls. The second is inflation risk, where purchasing power declines, or in other words, price levels are going up. The third is liquidity risk, where you cannot sell your security quickly or when you want to. The fourth being credit risk, where borrower defaults, or if someone that borrows from you cannot pay your loan back in time, or they cannot meet contractual agreements. The fifth is company specific risk, where poor management decisions are made in the company. Here we have the four main factors affecting risk tolerance. The first being age, where younger investors like yourselves can usually take more risk because the risk is spread out across a longer time frame. The second being your financial goals, where long-term goals allow for more risk. The third being investment knowledge, where with more experience and with greater understanding, it reduces your fear and it increases your risk tolerance. Fourth, and the most significant factor is your personality. Your emotional comfort with uncertainty greatly affects your risk tolerance. Here we have the three categories of risk tolerance. So we have the more conservative type of investor where they tend to focus on preserving their capital, meaning they try not to lose so much, or and in this case they would go for low volatility securities like bonds or keeping it in cash. In the middle we have the more moderate investor where they balance growth with safety. So in their portfolio you would expect to see a good mix of stocks and government bonds. And the third type is the aggressive investor where they focus purely on growing the portfolio, so they would accept large price swings, and in their portfolio, their majority would be equities or other words shares, which are high volatility. So it is important to understand the risk and return trade-off when investing. As the saying goes, high risk, high reward. So I'll give you a real life example. So for government bonds, these are low risk because they are insured by the government, but they produce a much lower yield, whereas higher risk securities like stocks or equities, it can lead to higher rewards. However, it is important to note that higher risk increases the possibility of higher reward. It does not guarantee it. So it is important to balance risk and return when making your investments. So here I've compiled three ways to manage your risk. The first being diversification. like every investor says, don't put all your eggs in one basket. It is important to invest in different companies, different industries, and different asset classes. The second being risk identification and investments. So here you would have to recognize the risk that you are dealing with. So the five investment risks that I previously mentioned, and you have to evaluate the likelihood of it happening and the potential impact of each risk before making your investment. The third being asset allocation. So asset allocation is the percentage distribution among asset classes. So this one you would have to agree upon in your groups. So for example, 70% equities, 20% bonds, and 10% cash. So this would be a more aggressive investors portfolio. So in your groups, you may decide to hold more bonds or more cash, which are low volatility. So here are some common mistakes in investing. The first being following trends blindly. So you buy and sell securities just because you've seen a social media influencer tell you to. The second being ignoring research. So you don't take time to research about the company, understand the company or industry, and that can cause significant losses. The third being emotional decision making. You, as someone told me, you cannot be too attached to your investment. You cannot lose control of your emotions because that will cause irrational decisions to be made. Stick to your strategy no matter what and listen to the brain, not to the heart. The fourth being poor diversification, where portfolios are clustered in one company or one industry, and that is a big risk because if that company or that industry declines, you would face significant losses. The fifth and the most common, I would say, is overtrading, where you excessively buy and sell securities without sound analysis just because you feel like being in the market is a must. So sometimes it is better to be out the market than in the market. So I want to end off with a quote from Warren Buffett where he says, risk comes from not knowing what you're doing. That's all from me. Thank you for listening and good luck in your investments.